Picture the world's monetary map as a giant chessboard. For 80 years, the United States has moved with the confidence of a reigning champion, its green pieces dominating every square. Global trade, energy, debt, even war reparations. Almost every move has been cleared in dollars. Yet far across the board, a new player is quietly rearranging the pieces. Beijing isn't announcing checkmate. It is carving pathways, raising new towers, setting subtle traps. The operation has a code name whispered in policy circles. China prepares the dollar's execution, and what follows is not an exaggerated thriller, but a methodical blueprint. 8 lethal instruments forged to pierce the dollar's armor and leave America's currency bleeding on the floor of history. In the next 40 minutes, we will walk through those blades, one by one, to understand how China is engineering the dollar's last stand and what a post-dollar world might mean for you, for markets, and for the geopolitical balance that shapes our daily lives. The storm is closer than you think, and its eye is opening now. The petroleum, the knife in the dollar's back. Oil is the oxygen of modern civilization, and since the 1970s, that oxygen has been bottled exclusively in dollars. Every tanker steaming through the Strait of Hormuz, every futures contract on crude, every refinery invoice from Texas to Tokyo, priced, paid, and settled in greenbacks. That single convention, known as the petrodollar system, forces nations to hold dollar reserves to buy energy. It generates a perpetual tide of demand that props up U.S. living standards and finances Washington's trillion-dollar deficits. China spotted the choke point and set out to sever it. In 2018, Shanghai launched Yuan-denominated crude oil futures convertible into physical gold. Skeptics called it symbolic, but sanctions on Iran and Russia funneled barrels into the contract and liquidity grew. By early 2025, average daily volume topped 1 million contracts, and Saudi Aramco began pricing trial cargoes to Asian refiners in yuan. Behind closed doors, Riyadh negotiated a broader deal with Beijing. Security cooperation in exchange for partial de-dollarization of Saudi exports. Hedge funds diversified out of dollar oil benchmarks. Sovereign funds shifted a slice of reserves into yuan. And U.S. diplomats realized the dollar's most sacred franchise had been breached. Why does this matter? Because energy is leverage. The International Energy Agency projects that China will import 10.8 million barrels per day in 2026. If even half those barrels clear in yuan, the renminbi's share of global payments could triple within 5 years. At the same time, producers punished by Western sanctions, Venezuela, Iran, Russia, can now route sales through Shanghai, pocket gold, and circumvent Washington's financial hammer. Critically, China is backing the scheme with hard assets. The Bank of China, ICBC, and state-backed funds are expanding vault capacity in Shanghai and Shenzhen to guarantee physical gold delivery on settled contracts. Wall Street traders now start each morning scanning both Brent and Shanghai quotes. The knife is in. It hasn't severed the artery yet, but every yuan-priced barrel weakens the pulse of the petrodollar. Once the oil market normalizes multiple reserve currencies, the symbolic monopoly the dollar has enjoyed for half a century will be gone, possibly forever. The financial nuclear bomb, the BRICS. Every empire fears an alliance of its rivals. In ancient times, that meant armies. In the 21st century, it means liquidity networks. Enter BRICS: Brazil, Russia, India, China, South Africa, plus a growing queue of aspirants. On paper, it is a loose political club. Beijing has repurposed it into a financial detonator aimed squarely at the dollar. At the Rio summit in July 2025, finance ministers agreed to settle intra-bloc trade in their own currencies, short-circuiting the dollar's circulation without inventing a euro-style union. Their new development bank is building a clearing platform that nets payments and stores surpluses in a common fund backed by gold and key commodities. Exporters will soon be able to swap Brazilian soy for Indian pharmaceuticals or Russian fertilizer for Chinese electronics. No dollars required. BRICS now generates roughly 32% of global GDP in purchasing power terms and commands more than half the world's oil and grain exports. If merely a quarter of those flows migrate onto the new rails, dollar-denominated trade shrinks by hundreds of billions a year. Washington's greatest sanction power comes from denying adversaries access to the dollar system. BRICS neutralizes that threat by offering a parallel universe. Russian banks blocked from SWIFT can clear through Beijing. Iranian refiners locked out of New York can invoice in rupees or yuan. Brazilian farmers can hedge locally. Each new sanctions package accelerates the migration. Critics point to internal rivalries. India distrusts China. Brazil values American markets. Beijing anticipated this. The clearing platform prices deals in a synthetic BRICS unit, referenced to the 5 currencies plus key commodities. No member cedes sovereignty, yet all gain insulation from dollar volatility. And just as nuclear strategy relies on second strike credibility, Beijing is lining up swap lines and gold buffers to ensure the system survives the first market panic. A nuclear bomb is most terrifying before it explodes. The BRICS grid is armed. Traders see the countdown in falling dollar shares on SWIFT. The digital yuan, the Trojan horse. Rome conquered with roads. China intends to conquer with code. The digital yuan is programmable, traceable, and, crucially, executable outside legacy banking rails. While Washington debates stablecoin rules, the People's Bank of China has already processed more than 2 trillion yuan in pilot transactions across 300 million wallets. Yet the domestic rollout is only the decoy. The real battlefield is cross-border settlement. M-Bridge, a joint experiment with the central banks of Hong Kong, Thailand, and the UAE, lets participants swap currencies in seconds. No SWIFT, no New York correspondent bank. In late 2024, the platform cleared a $22 million grain shipment from Bangkok to Shenzhen entirely in digital yuan, cutting settlement time from 5 days to 5 seconds. Beijing's strategy: export the rails, export the rules. Nations installing eCNY infrastructure adopt Chinese compliance standards. Beijing gains an invisible circuit breaker over their trade flows. Critics cite surveillance fears, yet digital convenience is addictive. African students in Guangzhou now pay tuition in eCNY via QR code. Indonesian exporters receive instant yuan for palm oil sales and convert on-chain. Each user deepens network effects. Every transaction executed in eCNY bypasses the correspondent bank ladder where the dollar extracts fees. Shrink that ladder and Wall Street's fee empire erodes. By the first quarter of 2025, the BIS estimates 29 central banks are testing digital currency corridors with China. Corporates noticed, in April 2025, Tesla's Shanghai Gigafactory paid a German supplier via direct eCNY to Euroswap, prompting Siemens and BASF to request similar channels. Money, like water, follows the path of least resistance. The wooden horse stands inside the city walls. Inside sits an army that answers only to Beijing. The gold grip, Beijing's secret strategy. Gold is civilization's oldest contract, accepted everywhere, immune to algorithmic fraud. Official Chinese reserves climbed to 2,292 tons in Q1 2025, marking the longest buying streak in modern history. Analysts suspect military-controlled entities hold at least another 1,500 tons off balance sheet. Why the obsession? Because gold is the only asset Washington cannot sanction or print. Each new purchase whispers that future yuan, or a BRICS unit, could be partly gold convertible. Exporters are told, hold yuan, and if politics sour, walk away with metal. Beijing also promotes the Shanghai Gold Exchange as a pricing venue equal to London and New York. In 2024, it launched a contract settling in either gold or eCNY, merging ancient trust with digital speed. Domestically, Lunar New Year ads urge families to gift 24-carat pandas. Provincial banks market gold savings plans. This grassroots absorption locks bullion inside national borders. Critics note gold lacks yield. Beijing replies that yield is irrelevant when the objective is credibility. According to CEEC, Beijing spent roughly 8% of its 2024 current account surplus on extra bullion, an historic ratio. Most crucially, the gold grip dovetails with the petroyuan. Shanghai oil contracts are gold exchangeable. Oil brings energy, energy buys gold, Gold secures currency. Currency challenges the dollar. Gold does not tweet or crash overnight. It simply is. And in Beijing's war room silence, that permanence is the loudest weapon of all. Strategic ports. Trade stranglehold. Global commerce is a network of arteries pulsing with container traffic. Through the Belt and Road Initiative, China has stitched itself into over 100 ports across 3 continents, from Gwadar to Piraeus and Lázaro Cárdenas. Ownership structures vary, equity stakes, 99-year leases, infrastructure loans, but the logic is identical. Control the choke points where goods and payments converge. A decade ago, Djibouti was a dusty way station. Today it hosts China's first overseas naval base beside a port run by China merchants. Flip a switch and invoicing shifts from dollars to yuan. Multiply that by Hambantota, Chankay, and Duisburg's inland hub and maritime occupation becomes monetary leverage. The mechanism: port operators set fees and financing terms. When a Chinese bank offers a 10% warehousing discount for yuan payment, logistics managers comply. Profit beats allegiance. In 2024, Maersk reported 18% of its Asia-Europe freight fees settled in yuan, up from 4% in 2020. Insurance giant PICC Marine Fast Tracks claims paid in ECNY. Host governments often welcome the trade-off. Greece's Piraeus port doubled employment. Pakistan's Gwadar free zone sprang from a fishing village. Jobs secure votes, and politicians trade currency preferences for infrastructure headlines. Meanwhile, every warehouse invoice that skips New York drains a drop from the ocean of dollar funding. Contracts include currency of choice clauses, allowing invoicing switches within 30 days. Once activated, global procurement software rewrites default fields from USD to CNY overnight, and the dollar moves from required to optional, a quiet status downgrade with historic consequences. Gunboats are obsolete. Spreadsheets and harbor cranes painted in Costco blue form an invisible tourniquet that can tighten around the dollar's throat at Beijing's command. The American debt, the suicidal weapon. Nothing fuels an empire like credit, and none has borrowed like the United States. Public debt passed $34 trillion in 2025, 124% of GDP. China still holds about $784 billion in treasuries. That is less than a decade ago, yet more than enough to shake markets. Beijing rarely sells in bulk. It lets rumors leak. A single headline hinting at portfolio diversification can push yields 20 basis points, costing Washington billions. China's strategists view treasuries as hostages and ballast. Why crash the dollar when controlled bleeding yields more influence? A slow sell-off forces the Fed to monetize debt, fueling inflation and eroding purchasing power. Proceeds flow into Belt and Road credits and LNG projects, assets that strengthen China's lattice. The suicidal aspect belongs to Washington. Every partisan debt ceiling standoff or multi-trillion stimulus advertises fragility. When Moody's cut its outlook in late 2024, the yield curve kinked upward despite a flight to safety. As BRICS clears more trade in local currencies, foreign central banks need fewer dollar reserves. Demand for treasury slips. Yields rise. Interest costs balloon, a vicious loop. China can accelerate the loop at will. A mere $50 billion sale would be absorbed, but the signal would ignite algorithmic selling worldwide. Hedge funds short the dollar. Exporters demand wider forward points. CDS spreads spike. The Fed responds with quantitative easing, feeding the very cycle it hopes to arrest. Debt is not merely an economic statistic, it is a narrative about future competence. Beijing's message: if the issuer can't manage its balance sheet, why trust its money? In that sense, US debt is a self-inflicted wound, and China need only keep the cut from healing. Africa, the monetary battlefield. If currency wars are fought in markets, they are won on frontiers where the next billion consumers will transact. Africa, median age 19, is that frontier. China arrived early with concrete and credit. Over $160 billion in loans since 2000, bundled with Huawei telecom gear and Ant Group payment pilots. In Nairobi, shops accept Alipay alongside M-Pesa. In Lagos, importers settle Yuan invoices via ICBC's local branch. The numbers are small in absolute terms, but huge in velocity. A single Nigerian clothing shop clears 10 QR code payments per minute, each a micro-referendum on which currency feels cheaper, faster, safer. China's edge is integration. It offers roads, rails, 5G towers, and the wallets that ride on them. By 2025, 10 African central banks had signed memoranda to explore ECNY corridors for remittances, promising to slash fees that devour 8% of diaspora transfers. When AFCFTA went live, Chinese engineers provided customs digitization software that stamped ECNY as an acceptable settlement option. Critics warn of recolonization, yet leaders judge by results. Infrastructure wins elections. Warnings don't pave highways. Each new milestone triggers escrow releases in Yuan. Each data center contract pays vendors in digital tokens convertible in Beijing. For the dollar, this is death by 1,000 cuts. Pan-African fintechs like Chipper Cash and Flutterwave are piloting Yuan rails to serve Chinese e-commerce exporters. Young Africans may soon think of CNY the way the post-war generation thought of USD. Wallets and smartphones are the new trenches, and every tap to pay is a bullet aimed at the dollar's supremacy. The day after, a worst-case scenario. Fast forward. It's 8 a.m. on a random Tuesday in 2029. Overnight, Saudi Arabia and Nigeria switch 40% of crude exports to yuan. The dollar index gaps down 3%. Gold and the BRICS unit surge. The 10-year Treasury spikes to 7%. The Fed launches another bond buying program, feeding an inflation-strangled economy. Imports seize up, manifests list yuan prices. Gasoline hits $9 a gallon. The S&P 500 sheds 30%. Public pensions wobble. NATO allies open yuan swap windows with Beijing. Washington's power projection looks pricey without monetary primacy. Domestically, politics fractures. Populists blame Wall Street. Progressives blame military budgets. Technocrats plead for a fiscal accord. Governors in the Pacific Northwest float regional trade pacts with Asia. Meanwhile, the digital yuan network processes 12 billion cross-border transactions that day without a glitch. Is this prophecy or pessimism? No one knows. But every mechanism we explored makes the scenario more plausible. The day after is not a date. It's a probability curve whose likelihood climbs with each ignored policy memo and each port contract signed in Beijing. The endgame may be a lingering demotion. The dollar survives, diminished, a regional currency for a once global empire. Its executioner long prepared the gallows in plain sight. We have traced 8 blades forged in Beijing's strategic forge and aimed at the petrodollar's jugular. None alone ensures the dollar's demise. Together they tighten a tourniquet with every yuan-priced barrel, every BRICS settlement, every digital wallet download. Whether you see China's campaign as enlightened multipolarity or aggressive hegemony, the force is real and accelerating. The execution has begun. The clock is ticking. When the last echo of the dollar's monopoly fades, will you have already adapted, or will you be caught counting on a currency that ran out of time?